Did you know that most retirees leave thousands of dollars on the table simply because they don't understand how Social Security works? That's right, for millions of Americans, Social Security makes up more than half of their retirement income. A program that was established in 1935 as a part of Franklin D. Roosevelt's New Deal, Social Security was designed to provide financial support to the elderly, disabled, and survivors of deceased workers. Today, Social Security provides benefits to almost 71 million Americans, including retirees, disabled workers, and family members. The average monthly retirement benefit in 2024 was approximately $1,907. Now, as an accountant and an investment banker, one of the most common mistakes I see retirees make is to not know how to maximize the Social Security benefits. And that's a big deal, as when and how you claim your benefits could mean the difference between just getting by and enjoying a financially comfortable retirement. So in this video, I'm going to break down exactly how Social Security works, how your benefits are calculated, and the smartest strategies to get the most out of it. We'll also talk about the common mistakes to avoid and how to integrate Social Security into your overall retirement plan. But before we get to it, if you are new here, I'm Amber, I'm an accountant and an investment banker, and I make content on finance and business with the goal to simplify complex issues into simple, understandable steps. If you like the content, please consider subscribing. Now, before we get into looking at the benefits of Social Security, let's do a quick walkthrough on the Social Security program itself and how it operates. Now, as I mentioned before, the Social Security program was established in 1935 with the goal to provide financial support for the elderly, disabled, and survivors of deceased workers. If you've ever wondered, am I going to get Social Security when I retire? You're not alone. It's one of the most common questions people ask when they start thinking about life after work. The good news is that the system is designed so that most people do qualify. But there is a basic requirement you need to meet first. You need 40 work credits. Now, what are work credits and why do they matter? Well, think of work credits like stamps on a Social Security loyalty card. You earn them by working and paying into the system through your paychecks. So here's how it works in simple terms. For every $1,730 you earn in 2025, you get 1 credit. You can earn up to 4 credits max per year, no matter how much you earn. To qualify for Social Security retirement benefits, you need a total of 40 credits. That's about 10 years of work. So whether you work full-time, part-time, or have breaks in your employment, as long as you eventually rack up 40 credits, you are in. Now, these 40 credits qualify you for retirement benefits, spousal and dependent benefits, and survivor benefits. You can check your credits and your estimated Social Security benefits anytime by creating a free account at this link here. If you don't have enough credits on your own, you may still qualify through a spouse who did, especially if you are married for at least 10 years or are widowed. Now, all of this is covered in this video, so please watch this video till the end and re-watch it if there is anything still confusing. Now, Social Security is funded through payroll taxes collected under the Federal Insurance Contributions Act or FICA. The current rate of tax is 12.4%. For people who are employed, this contribution gets split between the employees and the employer, who each contribute 6.2% of the wages up to a wage cap. Now, what is this wage cap? We'll just discuss it momentarily. Self-employed workers pay the full 12.4% themselves. The Social Security tax is also not applicable to your total pay. The maximum limit, or the earnings cap that I was talking about, on which the taxes are applicable, is the first $168,600 of earned income. Anything above that isn't taxed for Social Security purposes and doesn't increase your benefits. Once you hit this cap, you have maxed out for all the year in terms of contributions and benefit growth. So say for example, if John earns $20,000 per month or $240,000 a year, by August 13, he would have earned $168,600. After August, John stops paying the 6.2% Social Security tax, and so does his employer. Any income above $168,600, which in John's case is the additional $71,400, is not subject to Social Security tax and does not increase his future benefit. Well, now that we know how the Social Security program is funded, let's discuss what does the government do with the money it receives as taxes. Now, when the government collects Social Security taxes from workers and employers, that money is immediately used to pay current retirees and beneficiaries, a system known as pay-as-you-go. The taxes you pay today aren't saved in a personal account for you. Instead, they are used to fund today's Social Security checks. Any surplus collected, that is when tax revenue exceeds the payout, is deposited into Social Security trust funds which are held in special US Treasury securities. Now, these funds earn interest and act as a reserve to cover future shortfalls, like when retiree numbers grow faster than its working population. So, in short, most taxes are paid out immediately to current recipients. Any surplus is invested in US government bonds to earn interest. The reserves help bridge funding gaps as needed. Okay, now to the meat of the subject, benefits. So you have worked hard all your professional life and now you want to enjoy the fruits of your labor. But do you know how much you will be getting in Social Security benefits as your monthly checks and how you can maximize your benefits? In this section, let's take a look at that. Your Social Security benefit is based on your average index monthly earnings or AIME from your 35 highest earning years. Now, these earnings are adjusted for inflation and averaged. Now, why adjust for inflation? Because the Social Security Administration wants your earnings from, say, 1995 to be comparable to your earnings in 2025. So they index older earnings to reflect today's wage levels. For example, say Alice worked for 40 years. Out of those, her 35 highest earning years, when adjusted for inflation, account for, say, $2.1 million. Her AIME would be $2.1 million divided by 420 months or 35 years, which will be equal to $5,000 a month. Now, this $5,000 will be plugged into the Social Security formula. Now, if you have worked for fewer than 35 years, the Social Security Administration fills in those missing years with zeros, which can unfortunately significantly lower your average and your eventual benefit. Now, once your AIME is calculated, it's applied to a weighted formula to determine your primary insurance amount, which is the monthly benefit you'll receive at full retirement age. Now, I know I covered two key concepts here, weighted formula and full retirement age. Now, both of them are very important to understand, so let's go through them one by one. The Social Security system is intentionally designed so that workers with lower lifetime earnings receive a higher percentage of their income replaced in retirement compared to higher earners. Now, this is to ensure that those who earn modest wages and might not have access to retirement savings like 401k or private pensions still have enough income to cover basic living expenses when they retire. For 2025, the formula works as follows: 90% of the first $1,174 of AIME, 32% of the amount between $1,174 and $7,078, and 15% of the amount over $7,078. So, for example, if a person is earning inflation-adjusted $10,000 per month for 35 years, their AIME is $10,000. Applying the formula, 90% of $1,174 is $1,056, 32% of $5,904, which is $1,889, and 15% of $2,922, which is $438. The total monthly benefit at retirement is $1,056 plus $1,889 plus $438, which is $3,384 per month, or roughly 34%. Now compare that to our example earlier of Alice, who had $5,000 as AIME, and her numbers look somewhat like this: 90% of $1,174, which is $1,056, 32% of $3,826, or $1,224. Her total monthly benefit at retirement is $1,056 plus $1,224, which is $2,280 per month, or roughly 45%. So hope this helps you understand how AIME math works. Now for the next concept, which is FRA, or full retirement age. Now, full retirement age is the age at which you are eligible to receive 100% of your Social Security benefit based on your work history. Now, your FRA depends on your birth year. If you are born 1954 or earlier, your FRA is age 66. If you are born 1960 or later, then your FRA is 67. So this means that at age 66 or 67, you can start collecting your benefits. However, if you want, you can start collecting Social Security benefits as early as age 62, but your benefit is reduced permanently for each month you claim before FRA. That reduction can be up to 30% lower than if you had waited until your full retirement age. So for example, say Linda, who was born in 1962, so her FRA is 67. If her full benefit at 67 is $2,000 per month, but she chooses to retire at age 62, then her benefit would be reduced by 30%, bringing it down to $1,400 per month. That's a $600 per month permanent reduction, which adds up to over $7,000 per year for life. Now, there is this opposite concept also, which is called delayed retirement credits. If you wait beyond your FRA to start collecting Social Security benefits, you actually get rewarded. For each year you delay benefits past your FRA, your monthly benefit increases by 8%. Now this continues up till age 70. So in our same example for Linda, if she waits until age 70, which is 3 years past her FRA, her benefit increases by 24%, which is $2,480 per month. That's an extra $480 per month, or nearly $5,800 a year for the rest of her life. But there is no benefit waiting past 70. Your Social Security amount stops increasing then. So now let's move on to how you can maximize your Social Security benefits. There are two key strategies to maximize your Social Security benefits. First is spousal benefits. Now, Social Security doesn't just offer retirement income based on your own work history. It also provides benefits for your spouse even if they didn't work or didn't earn much. Now, this is especially valuable for couples where one partner was a stay-at-home parent or worked part-time or earned significantly less over their career. Now, this is called spousal benefit. It is a way to ensure both spouses have retirement income even if one never earned enough to qualify for their own Social Security. A lower earning spouse can receive up to 50% of the higher earning spouse's benefit at FRA. Now, there are some prerequisite requirements such as you must be married for at least a year to claim spousal benefit. The higher earning spouse must have filed their own Social Security benefit first. The lower earning spouse must be at least 62 years of age. However, if they withdraw early before their full retirement age, then the benefits will be reduced. Now, let's see this with an example. Say for instance, Mike worked his whole life and will receive $2,800 per month at his full retirement age of 67. Sarah stayed at home for much of her career and qualifies for only $800 per month based on her record. Now, at her FRA, Sarah can choose to receive 50% of Mike's benefit instead, which is $1,400 per month. Since $1,400 is more than her own Social Security benefit of $800, she would choose the spousal benefit. If Sarah claims it early, say at age 62, she won't get the full $1,400. Her benefit will be permanently reduced, possibly to around $980 per month, depending on the exact age of claiming that amount. Now, what about divorced spouses? Yes, you can claim spousal benefits based on your ex-spouse's record. If you were married for at least 10 years, you're currently unmarried, you're 62 or older, and your ex is eligible for Social Security. And here's the best part. Your ex doesn't even have to know you're claiming based on their record. It doesn't affect their benefits. The second aspect is survivor benefits. Social Security doesn't just stop when a spouse dies. In fact, one of its most powerful protections is survivor benefit, which provides continuing income for the surviving spouse and dependent family members. Survivor benefits are designed to help replace lost income after death of a spouse or a parent. In many cases, this benefit can be a financial lifeline for a surviving partner. The surviving spouse can receive 100% of the deceased spouse's benefit if it's higher than their own, as long as they wait until their full retirement age to claim and the deceased was receiving or eligible to receive benefits. Now, there are some eligibility requirements. You must have been married for at least 9 months at the time of your spouse's death. You can start claiming as early as age 60 or age 50 if you are disabled, but the benefit will be reduced if claimed before FRA. You must be unmarried, or if remarried after age 60, you are still eligible. And if you are caring for a child under 16 or disabled child of the deceased, you can receive benefits at any age. In our example, if Mike died, Sarah will receive Mike's full benefit of $2,800 per month. That becomes a new monthly payment going forward, not adding to hers, but it replaces because it's higher. So what about divorced widows or widowers? Yes, you are still eligible. If you were married for at least 10 years, you are 60 or older or 50 if disabled, you are unmarried or remarried after age 60, and again, your ex's family doesn't need to know, your claim has no effect on their family or benefits. Now, one key factor differentiating between spousal benefits and survivor benefits is the ability to switch between benefits. In the event of a death of a partner, the spouse can claim survivor benefits early and switch to their own benefit later if it grows higher due to the delayed credits, or take their own benefit first and switch to survivor benefits later. Now, this flexibility allows smart planning based on longevity, income needs, and household strategy. Now, apart from survivor benefits and spousal benefits, there are some other ways to optimize retirement benefits as well. Number one is work 35 plus years. Ensure no zero earning years are included. Second is work longer at higher income. Later higher earning years can replace earlier lower earning years. And coordinate with your spouse. Delay higher earners benefit to maximize survivor benefits. Now, coming to the last part, which is understanding Social Security taxation. Now, many people think Social Security benefits are completely tax-free, but that's not always the case. Depending on your other sources of income, you may have to pay federal income on a portion of your Social Security. Now, let's break it down step by step. The IRS uses something called as provisional income to figure out how much of a Social Security should be taxable. Now, think of provisional income as a way to measure your total income, including parts of what you may think are not taxable. The formula for provisional income is adjusted gross income plus non-taxable interest, like municipal bonds, plus 50% of your Social Security benefits. So, what does that mean for you? The IRS sets threshold. Now, once your provisional income passes a certain amount, part of your Social Security becomes taxable. For married couples filing jointly, the brackets are somewhat like this. Below $32,000, none of your benefits are taxed. $32,000 to $44,000, up to 50% of your benefits may be taxed. Above $44,000, up to 85% of your benefits may be taxed. For single filers, the threshold drops to $25,000 and $34,000. Now, let's say a retired couple has $30,000 from IRA withdrawals, which is basically withdrawals from their 401k. $10,000 in municipal bonds interest, which is basically tax-free, and $36,000 in Social Security benefits. Now, let's calculate their provisional income using the formula of adjusted gross income plus non-taxable interest plus 50% of your Social Security benefits. So, $30,000 IRA plus $10,000 of muni interest plus 50% of your Social Security benefits, which is $18,000, which gives you $58,000 in provisional income. Now, this puts them well above the $44,000 threshold. So, up to 85% of the Social Security income will be subject to tax. The tax rates will be applicable in the same way as their ordinary income per the IRS slabs. So, if this computation was to be done in 2025, their taxable income would be IRA withdrawals of $30,000 plus taxable Social Security of $30,600. Now, municipal bond interest is tax-free, so it will not be considered. So, total taxable income will be $30,000 plus $30,600 or $60,600. Now, they would be eligible for standard deduction, which in 2025 for married couples filing jointly is $30,000. Taxable income after deduction is $30,600. Now, using the tax brackets, federal taxes would be 10% on the first $23,850, which is $2,385. 12% taxation would be on the income above $23,850 up to $94,000, which in our case is $6,750, so tax would be $810. So total taxes would be somewhere around $3,195. So the key message here is that even though Social Security is not fully taxed, a large portion becomes taxable once you have other income like IRA withdrawals. And income from tax-free resources like municipal bond interest or Roth IRA withdrawals still count in the provisional income formula and can push your Social Security into the taxable range. Now, that was federal tax. What about state taxes? Do states tax provisional income the same way as federal government? Well, no, they don't. The provisional income formula used to determine how much of your Social Security is taxed is only used at the federal level. It's an IRS rule. The states handle it differently. Now, some states follow the federal treatment, meaning if the IRS taxes your Social Security, your state might tax it too, like Nebraska and Minnesota. Other states don't tax Social Security at all, no matter your income level, like Florida, Texas, California, and New York. And some states have their own rule for taxing Social Security, separate from the federal formula. For example, Colorado offers pension retirement income exclusion for people over a certain age, which may reduce how much of their money is taxed. It is best to Google your state and check out the tax rates. Now, let's discuss some of the ways in which you can minimize the tax impact. Now, there are some ways in which you can minimize the tax impact by coordinating withdrawals. Now, withdraw from taxable accounts first in early retirement to avoid pushing your Social Security into the taxable range later. Use Roth conversions before claiming. This can reduce future required minimum distributions or RMDs and help keep your Social Security tax-free. So we covered a lot. If you followed me all along, you now probably have an idea of how Social Security works and how you can maximize your benefits. Now let's summarize the benefits that I covered in this entire video. Don't claim too early. If you have other income, consider delaying benefits to grow your monthly payout. Minimize taxes by coordinating withdrawals. Withdraw from taxable accounts first in early retirement to avoid pushing your Social Security into the taxable range later. Use Roth conversions before claiming. This can reduce future required minimum distributions and help keep your Social Security tax-free. Think about joint life benefits. Think beyond just your lifespan. Delaying can secure a much higher benefit for a surviving spouse. And lastly, work with a financial advisor. Even one planning session can help you decide on the best age and approach for filing. Social Security is more than just a retirement benefit. It's a powerful income stream that deserves careful planning. Understanding how it's calculated, how to leverage spousal and survivor benefits, and how taxation works can help you keep more of what you earned. So don't rush to claim it early without running the numbers. Plan ahead, work a little longer if you can, and be strategic. Your future self will thank you. Well, if you like this video, there is more where this came from. Please feel free to check out my channel and subscribe if you feel the content resonates with you. Thank you for your time, and I will see you in the next video.